Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Garrett Marsilio of Delta-v Capital, and what I really enjoyed about this conversation is that Garrett and his team specialize in buying companies as secondaries, where they're buying out existing investors, finding LPs liquidity, and coming in on the cap table and then slowly helping transform the businesses and exiting them over time. And what's really interesting about it is in today's market, with firms struggling to find liquidity, hold periods getting longer, there are a lot of LPs putting pressure on private equity firms to exit faster to find liquidity, but there isn't enough demand on the sell side to find the capital required for those kinds of exits. And so secondaries present a different opportunity or an alternative means of finding that liquidity for the LPs. And that's the opportunity that Garrett and his team are really capitalizing on because by coming in as secondaries, they can find companies at reasonable valuations, help transform them, grow them, maybe even layer on M&A and other organic strategies to help drive more enterprise value, and then eventually exit those businesses and return the fund for their own investors. So I thought it was a super interesting conversation, and Garrett had a ton of great insight, so I hope you take away from it as much as I did. With that said, I'll leave you right to it. Enjoy the episode. All right, Garrett, welcome to the show. How's it going?
It's great, Shiv. Great to be on with you.
Yeah, excited to have you on. So why don't we start with your background and Delta-v Capital, and let's go from there.
Yeah, so I'm a partner with Delta-v Capital. We are a secondary and growth equity firm based in Colorado and Dallas. My background, Shiv, I grew up in Cleveland, Ohio. I went to school at Wharton for undergrad, and then I worked in consulting for a bit. And then I went over to work at a firm called Common Fund Capital, which is actually one of the largest outsourced CIOs for nonprofit and endowment assets. I was on their venture team for 2 years. And while I was doing that, I had a lot of fantastic experiences. And so we were investors in some of the leading venture capital firms of the world. And so think of Sequoia, Andreessen, Matrix, et cetera. and we did investments in those funds. We also did LP secondaries in venture funds as well as private equity funds. And then we did a lot of co-investing alongside our top managers. It was a large fund-to-fund and secondary fund model. We were investing out of the $525 million fund while I was there in the venture program. I then joined Delta-v in 2017. I joined as an associate. We were a small firm at the time, really investing out of our fund two. And fast forward to today, and I'm one of 4 investing partners with the firm. We're currently investing from our fund 5, and we built a team, and it's been a fantastic run. And I'd love to tell you maybe a bit more, Shiv, on Delta-v and our strategy, but I'll pause there for maybe questions on my background before I dive into Delta-v.
I mean, all that sounds great. I mean, tell me more about where the focus is at Delta-v. What types of companies are you looking at? What stage, and how much are you looking to deploy into those assets?
Yeah, great question. So at Delta-v, we're focused in investing in technology businesses, predominantly in North America. We invest across specific sectors. There's 4 sectors that we focus on as a firm. The first sector is cloud services or technology services companies. That's the sector that I spend time in. And then each of my partners spends time in other areas of technology investing. And so we also spend time in what we call infrastructure software, which for us is a lot of DevOps tools, as well as cybersecurity tools. We also do vertical software. And then we have a practice that we call CXO, which is horizontal software aligned to really key horizontal functions within an enterprise. So think marketing software, et cetera. And so that at a high level, that's the sectors that we focus on. And then we look to deploy capital really in what I think is quite a differentiated way. And so in our highest level thesis, Shiv, is that we see that secondary has really become the primary way for firms and LP and GPs and LPs to really generate exits and DPIs in the private capital world. Fundraising this year across private capital was down, except for secondary firms, and that's really a sign of just the market momentum that we see, where secondary has become really the primary way, especially for venture-backed companies, to derive returns and true DPI for their investors. And so that's a market opportunity that we're very excited about capitalizing on. And so what that means is we go and look for assets where there are those types of opportunities. And so those opportunities can exist in a few ways. One is there could be early investors in the cap table, Shiv, who are looking for liquidity, and we approach them and look for ways to provide them that liquidity. It might be members of management that have been in for the company for a decade, and sometimes even longer than that, and are looking for partial liquidity of what's effectively most of their net worth is tied up in a business. And we also see opportunities to back leading management companies and leading companies in M&A consolidation, and see that as a fantastic use of our capital. We're developing a relationship with a leading company, going out in the market and identifying, maybe the number 2, the number 3, number 4 players, and help, with that market consolidation, providing secondary to the shareholders that we're buying out in those other assets, and then consolidating our position in the stronger, leading company, going forward.
Yeah, expand on the secondary side. We've had a couple of episodes where we've had people talk this through, but just from your perspective, how is the secondary market generating return on the fund for firms, and how do you guys look at that? Walk us through structure and maybe potentially some examples there.
Yeah, so the secondary market has matured and evolved, and it's a fairly sophisticated, market at this point. And so I think at the highest level, there's what I'll call LP-led secondaries, which are initiated by a limited partner who wants liquidity, and then there's GP-led secondaries initiated by a sponsor or GP. And so within that, you see things like tender offers. You see things like just individual direct secondaries within a company. You're seeing a lot right now in the market on what's called continuation funds, where GPs may have a trophy asset, and they're looking to provide liquidity or at least an option for liquidity for their LPs, but but really want to continue to hold on to that asset. And you're seeing fund recaps and many other, types of examples. For us, where we focus, Shiv, is on what we call direct secondaries. And so this is where we bring in individual portfolio or individual asset underwriting to directly underwrite a particular asset. So this is unique to what I was doing at Common Fund. What's not uncommon in the sector, the secondary sector, is more of a portfolio approach where you come in, you identify an LP that may have a stake in a fund that's looking for liquidity of that fund, which means that there's a variety of assets underneath that are part of that transaction. That's not the model that we have. We believe that having an individual asset underwriting approach, no different than a traditional GP, whether that's a growth equity GP or a venture capital GP, really helps us generate returns relative to a secondary fund that I would say is much more of a index type of fund on the market, where we're taking more concentrated bets on companies. And so within one of our funds, we will have probably 15 to 25 companies in a fund. And you compare that to what I'll call a traditional secondary fund, which would typically have hundreds of assets within one of their funds.
And basically, you're finding a path for liquidity through the secondary market versus, let's say, fully exiting a business or from the buyout side, rather.
That's right.
Yeah. And do you see that becoming more popular now because the general buyout market, the valuations have come down significantly and LPs are putting pressure on funds to find liquidity sooner?
So I think that we're in a market right now where LPs are starving for liquidity.
Right.
And I think we've been in that market for the past couple of years, frankly. And so what we've seen is that the total market size for IPOs, the total market size for strategic exit has not kept pace with the amount of capital that's come into the private markets. And so what that means is there needs to be a third avenue for liquidity for good companies. And that's where the secondary market plays. And traditionally, it's been much more of a fund-to-fund type of model, I would say. And what's unique about what we're doing, I think, Shiv, is that we are applying what I call traditional GP best practices and capabilities into the secondary market. And so beyond the individual asset underwriting, half the time we'll serve on boards. We have sector expertise, so we're only focused on these 4 sectors. We don't invest outside these sectors. So if a consumer opportunity comes across my desk, we don't look at it, right? Because we don't think we can have a differentiated point of view on evaluating that asset. And then we also have a network of advisors. We call them our trusted advisor network that we leverage to bring into our companies, either as executives or board advisors or board directors, to help really add value to those companies post investment.
And so is that the main way that you're deploying your fund, is coming in as a secondary?
So our funds are about 70% secondary, about 30% primary capital. It's often, so yes is the answer. And the way we deploy capital is often a mix. And so there are times where we come into an investment with a small primary check. And then often we'll increase our position over time through secondaries. And there are times when we come in on a secondary basis, and we may support the company with primary capital going forward. That's often very attractive to an entrepreneur who, especially if they're trading out an older investor who's long in the tooth, maybe a venture fund who invested in them 10 years ago and doesn't have any capital to continue to invest in the company. Say if there's a strategic M&A that they want to do going forward. And so they view trading us for that type of investor as a trade up in the cap table. But it's generally about a 70-30 mix in our portfolio.
Understood. When you look at the way in which you're coming into these companies, I would imagine in a lot of cases, you're the minority investor, right? So how are you going about influencing companies where you don't have full control of the organization that you're coming into?
Yeah, it's a great question. And so I'd say we are highly focused on alignment when we come into a business. And so what we do is speak to the other board members. We speak to obviously the management team. We require full access to information. We do not do secondaries where we're buying from an employee and we don't have any access to information. That's not our mode. And through those conversations, we really try to understand what the exit path is to the company and whether we're aligned to that exit path. We do substantial diligence on trying to identify who the strategic buyers are of an asset. And so a recent investment that we made, I actually spoke to 13 different corp dev departments of buyers of this particular asset to get confidence in the exit path of the business post our hold. And ultimately, because we're coming in at a bit of a later stage in these assets, and because we do so much diligence on the exit path, that leads to a shorter hold time for our investments relative to what we think is industry, certainly for venture, but also even candidly for buyout funds. And so the average time to exit of a realized investment in our fund is 3.7 years. I think for venture, it's 10 plus years. I think for buyout, it's in the 7 to 10 year range. And that's really a direct result of our strategy here.
Is that because when you're buying these companies out from an existing investor, are you getting a better valuation? Because they're kind of like, and maybe that's not the case, but I'm just trying to understand the dynamics where maybe they have certain expectations on what they need to exit for, and they're willing to exit from on a secondary basis to get some sort of a return or liquidity, but then that positions you as a firm to be able to exit at less aggressive multiples. Is there some of that at play here?
Absolutely. So as part of the negotiation with a seller, we have a conversation on what we call the discount relative to what could be fair market value if there were to be a majority transaction. And the reasons for that discount are a few. One is in a strategic majority transaction, buyers often pay a premium, right? Because they're gaining full control of the company. And so we have what we call just a liquidity discount. When we come into an asset, that range varies widely. It really depends on the preference stack in the company, what security we're buying, whether we're buying common stock or preferred stock. It depends on the health and the growth of the company, et cetera. But some of our money is made on what we call the buy, where we come in at typically it's a modest discount to what might be fair market value in a majority sale transaction.
Mm-hmm. And then from your perspective, then because you're trying to build to a different type of exit path, you are able to do it in almost a shorter time frame. Is that fair to say?
That's right.
Yeah, I guess is part of the dynamics here also that a lot of the companies that are eligible for this type of an investment, they're coming from this VC world where maybe they've raised too much capital or there are these growth expectations. Is that the, if you will, ICP of types of companies that you're kind of going after, or is it also from the private equity market?
Most of our companies fit in one of two categories. They are either we don't tend to buy too often from private equity backed buyers. They are majority owners of assets. They're driving, they have control of the cap table and they're driving an exit in that asset. Where we see the most opportunities is really with venture backed businesses where there is a disparate number of individuals on the cap table, and having a number of folks in the cap table, often none of which singularly control the exit, can lead to a divergence and expectations around exit. And so there could be some investors who are at the tail end of a fund who really need to wind up the fund. There could be some investors who their LPs are telling them, hey, you really need to show DPI for your next raise. There could be an individual who's looking for personal liquidity because he or she is no longer with the business and just wants to generate liquidity to move on to his or her next venture. And so that's where we see the most opportunities, where there's a wide number of individuals on the cap table.
That makes a lot of sense. How often are you coming into a company where there's a ton of inefficiency or overspending, or they're maybe not even profitable, but they easily could be if they cut out some of the excessive spend because they're coming from more of a VC world to now this, I would say, a mindset to exit and be more and more prudent with their finances?
The answer is yes. We have seen a number of venture-backed companies who have tried to continue on what I'll call the venture Silicon Valley playbook. And sometimes they've run that playbook all the way to the end, where they've been trying to raise capital as they've been burning and don't have the unit economics. I think the market has shifted where that you have to have a plan to profitability and strong unit economics in order to raise capital, just period, full stop, from institutional investors today. And so majority of businesses today that are out looking for capital, I think, have already begun making that pivot. What we do when we come into a business is we do two things. One is that we make sure that there's a appropriate level of cash in the business relative to the burn plan. And so often the businesses we come into are about break even or profitable. And if they're not, the heuristic that I use is making sure there's at least 2 times as much cash on the balance sheet relative to the burn plan to mitigate the risk of needing additional capital to come in the business, as part of our hold. The second thing we do, and Shiv, we take board seats about half the time of our investments. And so where we do take board seats, we're more influential in this. But regardless, any investment we make, we put together what we call the Delta-v flight plan, which is effectively a value add plan for our post-investment activities with the business. That largely falls in, I'd say, in a few areas. The first is people. And so what we try to do is really work with proven executives that we worked with before and bring them into a business. And so as an example, we recently recruited a CFO into one of our recent portfolio companies who is very successful at a prior business and is a very strong individual. We also can provide a lot of help and capability on the M&A front. We supported several dozen acquisitions across our portfolio companies over the past few years, and that includes from a sourcing to an execution perspective. And then the third is really just bringing in board advisors and board directors from our network who can just be really experienced, steady hands, and serve as mentors and strong directors to a CEO.
Yeah, and how often? I was going to ask about the people side because there's a bit of a change in operational discipline and cadence and just approach to building a company in this post-secondary world versus in the VC world. So how often are you needing to overhaul the executive team?
I personally don't like to come into companies where I feel like the leadership at the top is not strong. There are investors who have a playbook for doing that and come in believing in a particular asset and then trying to, or often successfully changing the management team out. That's not our model. And so a lot of the diligence that we do is around the strength of a management team and believing that they're aligned and capable for the next journey of the business. And so, we employ a variety of tactics here. One of them is we actually have a business psychologist that comes in and spends about half a day with an executive, provides us an independent assessment. We do our own interviewing, of course, of direct reports and references. But it's a big part of what we do is really, making sure that we are believers in the team. In my experience in my career investing, Shiv, that the businesses where we've had to change out the management team post-investment have not been as successful as the ones where we've been able to come in and back a strong team from the get-go.
Got it. And as you kind of think about I guess the people side is one side, but when you look at this overall Delta-v flight plan, I like that you mentioned that. What are some of the other elements that you guys are looking at on the value creation side to help scale these companies?
Yeah. So one of the things that we ask all of our companies to do post-investment is put together what I'll call an exit scorecard. And so through our interviews with buyers and corp dev departments of buyers of these assets, we identify, hey, these are the strategic areas that need to evolve over our hold period. And it could be things like new product areas, that could be new geographies to expand into, et cetera. And in each board meeting, we ask for reporting on that exit scorecard to understand the progress that the company has made towards the metrics that we think are most relevant for a strategic buyer of the business. And that's had a lot of success for us across our portfolio, really making sure that the asset that we're helping to build is built for a buyer at the end of the day.
Understood. That makes a lot of sense. When you think about on the M&A side, I think that's one thing that you had opened up earlier, and I'm curious about that in the secondary world. Like you're buying out these companies, and then you also mentioned consolidation as part of the playbook. How does that tie into the financial engineering and the dynamics that go into the playbook there?
Yeah, I'd say at the onset, what it does is it really helps us attract the best businesses to Delta-v, because often the entrepreneurs are looking for an investor who has true value add capabilities and a track record. And having a track record in M&A execution is often quite valued by entrepreneurs that we're interacting with who have a particular vision that they'd like to execute on that front. So that's the first one. And then as it relates to the financial engineering piece of it, often we see opportunities for assets that are a leader in the market to go out and buy the number 2, number 3, number 4 player at a more attractive valuation because they're not the leader, right? And as they buy these assets and consolidate them under their umbrella, often there's quite an attractive arbitrage to be had in those types of consolidation plays. But look, it has to work from a strategic perspective first and foremost. M&A for the sake of M&A does not work. The fastest way, the best way for equity creation, in my view, is true organic growth. One, that you're growing, but two, that the growth is predictable. And so that means that you're hitting budget. You're able to predict your expenses. The second one is really having a strong management team, and with some individuals who have experience going through M&A and experience with integration specifically. Integration is a heavy people-based process, Shiv, and really having the experience to understand how do you bring in two teams, create one unified culture going forward. That's something that needs to be thought about beforehand, and we value folks that have experience doing it before we actually go and execute that plan. And then the third one is really, having a clear strategic roadmap for what it's going to achieve. M&A for the sake of M&A does not make sense. And so understanding whether you're filling particular product gaps that you can then cross-sell into your customer base, perhaps you're adding new geographies and new markets that you think are quite attractive to your product and offering. Those can be good reasons for considering M&A. But really having thought about that, having board buy-in on that before you go down that path is really critical.
Yeah, totally agree with that. We see a lot of companies when we're getting brought in by investors where their basic go-to-market is not in a good place, and then they layer on a ton of M&A, and now you have all this integration work to kind of manage, and then the organic growth is not doing as well as you want, and so now you have to kind of force growth to happen through cross-sell and upsell, and some of those things are not as natural inside some of those companies. So we see a lot of wasted effort, and then projections are missed, and then a lot of downside kind of consequences that come from that.
I think one of the things to think about too as an entrepreneur is thinking about M&A is really stare hard at what the requirements for growth will be after the acquisition. And so what I mean by that is if you buy a similar sized company, well, then your pipeline is going to have to double, post acquisition to continue to, have a healthy growth rate. And are you going to be able to actually execute that sales plan post acquisition, or are you going to enter into a period of low or no growth? And what's the probability of that occurring relative to your ability to grow today on a standalone basis?
Totally agree with that. That makes a ton of sense. Last area I kind of want to just touch on is talk about AI, because we get so many different investors on the podcast. Like, I'm curious what your take is on this, especially as you're deploying capital as a secondary into these companies. How much are you trying to layer AI into the investments? How much is that factoring into your investment thesis or the markets or verticals that you're kind of investing in? Just help us understand that.
Yeah, so I think it is the topic of the year, of the decade, really. And for me, and if I step back a bit, Shiv, I spend most of my time in what I call the IT services or cloud services world. And I think we are absolutely seeing a tremendous market shift in this world where we are beginning to see a shift away from a labor model to an outcome model. And we're still quite early in that transition, but I absolutely believe it's occurring. And there's, and I think that the companies that can identify ways to deliver business outcomes and tie their pricing models to business outcomes, as opposed to things like time and materials or hourly based pricing or seat based pricing. Those are going to be the winners over the next decade in not only services, but candidly in software. If you just think about sales and marketing, all sales and marketing is at the most simple, you put it simply, is a executive wants to know, if I put $1 into my S&M machine, how many dollars am I going to get out? Like, that is the only question that really matters at the end of the day. And everything else sort of is an educated guess that the executive is making on, if I buy this service or I buy this software, it's going to improve that sort of ROI calculation. And so the companies that are able to more clearly tie their product or services to exactly that business outcome are going to be the ones that are successful. And so we are seeing increasingly just experimentation with pricing models, shifting away from, seat based or hourly based, or even fixed, pricing models to business models that are tied around more of an outcome. But I'm not yet seeing that model. There's innovation occurring, but it's not clear who's going to win yet. And so to me, that's where I'm spending a lot of my time, is really asking businesses that I'm speaking to, how are you trying to drive your business to be successful in this world? That's really, all about business outcomes.
Yeah, that's fantastic. As we're coming up on time here, if folks that are listening want to get in touch with you, if there's somebody that's looking for a secondary, how do they get in touch with you or learn more about Delta-v?
Yeah, great question. And so I would say for any individual who sees an opportunity in our sweet spot, which I'll define as companies in our sectors. And so these are cloud services companies. These are infrastructure software companies, which include cybersecurity companies. This is CXO companies, and this is vertical software companies. And those companies are seeking to raise capital for the following reasons. One is provide secondary liquidity to individuals or institutional investors. Second is to really go after M&A opportunities in the market. And as part of that, there can be a primary capital raise need as well. We really encourage those folks to reach out directly to us. And my email's Garrett at deltavcapital.com. And I think all of the partners' contact information is on our website, which is deltavcapital.com. And we would absolutely welcome a conversation.
Awesome. That's fantastic. And Garrett, I want to thank you for sharing all of that. We'll be sure to include all of that in the show notes so that everyone has access to that. And with that said, thanks for coming on and sharing your wisdom about the secondaries market and your approach and how you guys are creating a ton of enterprise value. So I appreciate you doing this.
Thank you, Shiv. Have a good one.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.